Hello and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss a future episode, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Chris Scott, Investment Manager based out of our Glasgow office. And this week, I'm pleased to be joined by Richard Carter, our Head of Fixed Interest Research. Good morning, Richard. Richard, last week was a busy week for inflation data and central bank meetings for both the Fed and the Bank of England, despite holding rates as they are, gave some positive indication that rate cuts are in the not too distant future. Can you summarise the data we received last week and what you think may be the final push for central banks to make cuts?
Yeah, good question, Chris. I mean, I think, it was a busy week for central banks last week, but they certainly seem to be heading in the right direction in terms of the path towards interest rate cuts, and that's certainly been helping markets recently. So we saw slightly weaker than expected inflation data out of the UK, down to CPI down to about 3.4%, and it looks like over the next couple of months or so it could be heading down towards the 2% target. So that's very encouraging. There are still concerns here in the US about strong labour markets, and we're not quite sure where the oil price could potentially go given all the sort of geopolitical risk. But it looks like interest rate cuts are potentially on the horizon, and that was what the both the Federal Reserve and the Bank of England was saying. So that was good news for bond markets, good news for equity markets. And at the moment, markets are basically expecting the first rate cuts to come potentially as early as June, and then we may get sort of three rate cuts or so over the rest of the year.
We also saw some changes from the Bank of Japan and the Swiss National Bank last week. Can you talk us through what we heard from these meetings?
Yeah, so obviously, main focus week to week tends to be, ECB, Bank of England, and Fed. But we shouldn't forget, there are some other pretty important central banks out there who can, have an effect on asset prices. It was interesting because these two central banks you mentioned, Bank of Japan and the Swiss National Bank, very much heading in the opposite directions actually. So we saw the first rate hike in Japan. For a number of years, they've had negative interest rates in Japan for a long time now. Obviously, trying to battle against low inflation or deflation, and they sort of seem to have won that battle actually. So we've seen inflation picking up. Economy's been relatively strong, and recently we had the results of the sort of big union pay negotiations, and the wage settlements were pretty strong. So that suggests that inflation is becoming sort of self-fulfilling or quite permanent in Japan, certainly for now anyway. So Bank of Japan raised interest rates. Although they were fairly dovish with their tone, they're not expected to raise them too far over the rest of the year. But obviously, that's now the general direction. And then in Switzerland, completely opposite. So inflation's been coming down in Switzerland. They've had a very strong currency there, the Swiss franc, and they decided, a little bit to everyone's surprise, that now was time to start cutting rates to weaken the currency a little bit, and because they probably won the battle on inflation. So I think there was a lot of people looking at Swiss National Bank meeting last week and thinking, well, if they can do it, the Europeans and the UK and the US might not be too far behind. So we'll have to wait and see on that. But that would be great news if so.
Absolutely. As the head of fixed interest, what impact will these cuts have in the bond markets, or are the cuts largely priced in?
Yes, I mean, bond markets, all markets, they move around in terms of what their expectations are, but they are looking, 6 months, 9 months, and further out in terms of where central banks are going. So, rate cuts are already priced in to the bond market for this year. As I said, I think the first one is expected to be in June in the UK. So I think it might come a little bit earlier than that, and there's expected to be around three rate cuts this year. And you can see that if you look at the yield curve in the UK, it's downward sloping. So basically, in simple terms, it means that the yields on very short-term bonds are higher than they are if you go 2-3 years out. So yes, they are priced in. I mean, the risk, I guess, for bond markets is that, you know, we never quite get there. You know, central banks keep talking about rate cuts, but actually the data remains strong, and they never quite get to cut rates, which would probably, you know, which would likely cause higher bond yields. But I think as long as the general direction is towards rate cuts and inflation keeps coming down, then that's probably pretty good news for bond markets.
Absolutely. And lastly, despite inflation coming down in the US slightly quicker than in the UK, US Treasury yields seem to be higher than that of UK gilts. Is this part of some lingering fear that Trump will be in the Oval Office at the end of the year, or is there another reason that they're more attractive?
Yeah, that's good. That's a good question, actually. I mean, there are a few different reasons. I mean, it's interesting you mentioned Trump. There is you know, obviously some way to go until the election, but yeah, there is a bit of chatter around that. You know, US has got a pretty big deficit. There's huge amounts of fiscal deficit. There's huge amounts of treasuries being issued, and the risk is that Trump gets in, you know, slashes taxes and goes on a spending spree, and then lo and behold, you know, that pushes up the issuance of treasuries and potentially pushes up interest rates as well. So there is some fear of that. I think in the UK, we've kind of, in some ways, the government's learned its lesson from the mini budget and Liz Truss and all the rest of it. They've got to have a slightly more sensible fiscal policy. So maybe that's helping, or keeping gilt yields a little bit lower. That said, I think the main reason is the strength of the US economy. I mean, you know, UK's been obviously slowing down. It's actually, you know, technically in recession, whereas the US economy's been doing pretty well, and I think that means that, you know, the Bank of England may ultimately have more scope to cut interest rates than the Fed, and also, you know, UK inflation has been slow to come down, but actually the outlook for the next 6 months or so is that inflation here will fall below that of the US. So there are a few things going on there, but I think ultimately gilt yields, you know, treasury yields, they tend to move pretty much together. And I think as long as central banks are doing the same thing, that's likely to continue.
Well, thank you for those great insights, Richard, and to all of you for listening. If you enjoyed the podcast today, why not leave us a review wherever you're listening, and share us on your social medias and tag us at Quiltercheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, but in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on markets, industry insights, and upcoming events and webinars on our website and on our social media pages. Finally, if you have questions you'd like to ask one of our experts, simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. So thank you, Richard, for your time, and to all of you for listening. See you next time.